What's going on, guys? Welcome back to the channel. In this video here, I wanted to just touch upon something that's come up and just get my insight about it, and that's Tesla issuing another stock split. So rewind back to 2020, Tesla issued a 5-for-1 stock split. So, and in case you don't know what a stock split is, essentially if you own one share of Tesla and they issue a 5-for-1 stock split, you will have in total 5 shares. So you will be awarded 4 other shares as a dividend, essentially, along with the share that you already have at the split adjusted price. Now, fast forward to 2022, and Tesla just announced that they're going to be doing a 3-for-1 stock split. Here's the problem I have with this, and it's not so much with the company, it's more so with the investors that want to get into this company. Let's say the stock price is at $850 currently, based off of what my software is showing me here. Let's say it remains at this price and it splits for 3. Now the stock price will go down to about $280, $283 if my math is right. So now, in doing so, it becomes more affordable for companies or for investors rather to invest into this business. But the main thing people have to realize, though, is that it doesn't change the valuation of what this company's been doing. Now, I've covered Tesla in the past, and I've done a few stock analysis videos on this business, and over the growing trend with this company is that it's consistently coming up overvalued. Now, having the share price decrease essentially via stock split is not going to really change the valuation because the company is still doing whatever it's still doing. So loading this up in my stock research tool, and you just take a look at this business and going through the different metrics here. With our company metrics, we're looking at the 5-year averages compared to the trailing 12 months. Financial valuations, we're looking at the cash flow statement, the balance sheet, and the income statement. And Tesla has a lot of issues. We're grading this company a 5 out of 10. So here's the one thing, folks. Just because a company is going to be essentially cheaper to buy in stock price doesn't mean from a valuation perspective that it's trading at a bargain. Because nothing is actually changing other than there's just more shares on the market. So something to look at from a fundamental perspective before you decide to jump in, whether I should jump in before or after the split. And the only reason that they're doing that is to raise equity ultimately for the business. And they are no strangers to issuing out more shares. As we see with our share dilution here, folks, that's 2.71% increase of shares over the last 5 years. So doing these stock splits help them overall in the long run because now people can essentially buy in at a cheaper price, raising the share price up, raising their market cap up overall. This is almost $1 trillion company, and it did hit $1 trillion. As our 52-week range indicates, we went up to $1,200 a share at this current share count. But what exactly are you paying for? You're paying for a company that just made profit pretty much in 2019. You are paying for a company that has average free cash flow of, let's say, $500 million. And the current cash flow is $6.93 billion. These are numbers that the company's just providing us, right? The average profit margin over the last 5 years is -2%. Average return on equity is -11%. Only recently has these numbers have been positive. So what exactly are you really paying for? I like Tesla. I like their cars. I like Elon Musk. However, you have to just come to facts and realize that this business overall, it's overvalued for what they're actually providing you. So when it comes down to this whole, oh, Tesla's doing a stock split, pump the brakes and analyze, am I getting a good deal on this? And I'll tell you right now if you're getting a good deal on this, because look, we're going to jump into a price analysis and I'll input these numbers in. And my software will tell you what you should be paying for this company. Granted, this is pre-split. So once the post-split numbers come out, I'll do another video, but it's roughly going to be the same based off these numbers. You could just take it and then divide it by 3. is I'm going to fill out these boxes here, and we'll talk about it in just a quick second. Okay, folks, so if you enjoyed the video so far, make sure you hit that like button and the subscribe button. I'm going to load this up now in the price analysis section, so take a look at this. So with my numerics here, I've priced out Tesla, assuming they do 20%, 21%, 22% revenue growth over the next, not 20 years, we're going to do 10 years. But here's the thing, folks, like this is a $1 trillion company. Revenue growth shouldn't be growing that much considering the market cap of this business. Now with profit margin, I had to speculate a little bit and go 10, 11, and 12 based off the 1 year number and trailing 12 month numbers that I'm being shown, or else I'd be playing with some negative numbers that I've seen in the 10 and 5 year. Going forward with our free cash flow margin, same thing. I try to be as conservative as possible, going 4, 4.5, and 5% based off our historical 1 and 5 year numbers. PE ratio and price to free cash flow, I kept it under 20 to keep it something rational with a desired return of 13%. I'm going to click calculate, and the software is going to do its thing and figure out what the average calculation comes out to be. But here's the main problem that I have with Tesla. It's driven so much by the community and by hype and 17-year-old kids that just love the stock, have no idea what's going on. And this, I have no doubt in my mind that this company is going to start skyrocketing again. And here's the thing. Let's look at what we have. Going back into the price analysis, our average calculation comes out to be $262, and the current price is $850. Guys, basically, it has to fall down naturally to the price they want to split to for it to be a fair value company. Maybe my revenue growth numbers are somewhat conservative, but here's the thing, folks. 20% is, I think, lenient, more than lenient in terms of a company like this. Same thing with profit margin. I gave 10, 11, and 12. This is just simply, it's just an overpriced business. Now you take that $262 number and you divide it by 3. That's what you're going to probably be paying for it, or you should be paying for it post split. But here's the thing, folks. People will continue to buy it. Your job as a rational and an intelligent investor is to give yourself the most margin of safety as possible and buy quality businesses at a great price. One day I will own Tesla. It's just not today, nor post split. It's going to be a day when I can see consistency and I can see the price of this company fall to a more applicable price given the status of the company and what they've actually been performing and what they've actually been producing. Because at $1 trillion market cap, and in terms of moving vehicles, their one main source of income, or not main source, but their biggest source of income, they can't compete against the likes of Toyota. They can't compete against the likes of GM and Ford, who move exponentially more vehicles than them. However, they have $1 trillion market cap underneath their belt. It's the perception, folks. The stock price is the perception of the company, and you shouldn't be wrapped up in smoke and mirrors. So until there is fear in the air of this company and this price eventually comes down, which I have confidence that it will, I'm avoiding this. But if you want to get your hands on this software, folks, stay tuned. It's going to be available soon to you, my viewers and subscribers. Let me know what you think. If you enjoyed this video, what are your thoughts on Tesla? What are your thoughts on the split? If you want to see a company analyzed, write it down in the comment section below. I will see you in the next one. Thank you so much for watching.